Welcome to the Balancing Act podcast. On this episode, we'll be discussing IPO readiness and key considerations for going public. An IPO is a transformative event for a company, requiring careful planning and coordination among legal, accounting, and tax advisors. The regulatory implications are complex and extend beyond the IPO itself, affecting the company's structure, compensation, and ongoing compliance obligations. Early and thorough preparation is essential to ensure a successful transition to public company status and to avoid costly tax and regulatory pitfalls. I'm Mike Mondelli, a director in SingerLewak's Tax Advisory Group. Joining me today from SingerLewak are partner Eric Weis and director David Finkelstein, and a special guest from law firm Latham Watkins, Steve Stokdyk, an attorney who has handled over 100 IPOs. Gentlemen, thank you for being here today and welcome to the podcast. I was actually out visiting LA last week and the weather was so unseasonably hot. It was in the 90s. I was loving it. But then I got home to Minnesota on Saturday morning and we got 10 inches of snow and the temps dropped down to the 20s. But if you can believe it, it's going to be 70 degrees here tomorrow. So crazy things are happening with the weather.
It's like an early spring there. That's great.
Yeah.
It's an early summer here. It's in the 90s. So we're lucky to be joined by Latham Watkins today, one of the top IPO law firms in the United States. So let me turn it over to Steve to talk about the equity story and KPIs.
Great. And this is one of the most fun parts about an IPO is helping a company craft its story. And just so you know, KPI is referring to key performance indicators. So what that means is, you as a private company are going to be spending, time talking to investors and you kind of honing your story. As you get closer to an IPO, this really accelerates. You're going to be telling your story way more times to different investors, different groups of investors. You're going to be telling it to investment banks. You're going to be telling it to their research analysts, and all of them will have a different view of your company, a different way of thinking about it, things that your competitors or other similar companies may be doing as well. And this may help shape how you're thinking about the company. And so as part of that process, you may start with, hey, these are the 3 things that we think are really important to how we measure our business. For example, like, number of customers, just something very simple like that, or revenue per customer. And it could go down a whole bunch of rabbit holes depending on what your particular industry is. But this will often change. For example, investors might want to look at how many of your revenues are recurring revenues. And so that may become a key performance indicator as well. And so this could change as part of the process and testing. You might come up with different, or you might jettison some of the ones you currently have. And I've seen companies that I've worked with even actually change their business model somewhat based on that, look, investors really like XYZ type of company. With these type of margins and these type of performance indicators, and so the companies will actually start changing their their products or the way they approach the market to try and address that. And so, but that's kind of an add-on effect. The main point is putting your story together that's the most compelling one to the investors and the research analysts that are going to be covering your stock. And these are indicators that once you set as part of the IPO, these will be what you're measured going forward. So it's really important to find ones that you can hit that are going to be positive, to put your business in a positive light, and will show a positive trend going forward. So you don't want to pick something that may have looked good for the last 3 years, but going forward, you're like, yeah, I don't know if that's going to really put us in a good light going forward. So that may be one that, yes, it might have been important to you previously, but you decide not to use it. So there is a lot of judgment here. There's definitely not one size fits all. And this is something that you really got to spend a lot of time with your advisors on and some of your investors and board and try and figure out what really works for your company and what puts your company in the best light. Secondly, kind of one maybe thing related to this is, as part of the IPO, everyone is familiar with the prospectus, and you spend a lot of time telling your story in that. But equally as important, there's going to be a PowerPoint roadshow deck, which takes that and presents it in a different way and presents your story. And so both of those need to match up. So the slide deck you've been using to investors, yes, once again, that could radically change, and different things could be emphasized in that. And, we as lawyers will make sure that your story in that deck matches your story that you're telling in your prospectus, and it's a consistent story to the market, over and over and over again.
Eric, for a private company planning an IPO, what are some of the first SOX-related requirements they should start thinking about, and what would the timeline be?
Before I answer that question, let's go back in time a little bit. So why do we have SOX? And I know this, but I don't know if everybody still knows this. Let's travel back in time to the year 2002. That was the year of, I looked this up, the first year of American Idol. Kelly Clarkson was the winner. That was a long time ago, 2002. But what also happened that year, that was the first year of SOX. And so why do we have SOX? Unfortunately, before SOX, we had companies, we had Enron, if you know the name, we had WorldCom, we had Tyco, and unfortunately, they were cooking the books. Because of that, it spooked the market. It spooked the market, and the market said, how do we know public companies are reporting the numbers accurately that they're giving to us, that the public market and investors are putting their money into? How do we know that? So the answer that they came up with is Sarbanes-Oxley. And so it gives, and it's not perfect, but it gives the basic requirements needed for operating a public company. So how do we know that those books are correct? Because there's controls in place that are established within the company. So that's what SOX is. The tricky part is not only do you have to operate like a public company, okay, you do, but you also have to prove that you can operate like a public company to the SEC. And you do that through policies and procedures and documentation and testing. And those results are in place to prove that you can operate like a public company. Getting people operational, that's what I was referring to as the marathon. It takes time to get that in place. As you know, anytime you change something in an organization, it takes time for it to become mature, to operate the same way over time. And it has to operate the same way over time because you're going to be tested on it, and you don't want to fail of those tests. The goal then is reliable financial reporting and to have a culture of accountability. And just to throw out, you probably know this, but some of the key process areas that are very common are revenue and receivables, purchasing and payroll, or purchasing and payables, payroll and HR, et cetera. There's entity level controls. There's financial reporting controls and your close process. And then there's IT general controls that I can get into a little bit more.
Yeah, the only thing I would add from that, just from the pure lawyer's perspective here, is like we have a very tiny role in assisting that, but we do see a lot of it from the company. And actually, having done many IPOs pre-Sarbanes-Oxley, I kind of see the difference. And basically, there's just a huge amount of paperwork that the company needs to generate internally. One, to have all the processes, and then two, document that you're actually complying with the processes. And so that's one where it does take the finance department a lot of time to do that. And some of those are also technical as well too. And a lot of companies will hire SOX consultants. There's a whole industry that is related to that, who helps people put together these memos that they're not used to putting. They're more focused on running the business itself and not running policies and procedures. So you can look at that as a whole additional work stream, as you're preparing just the normal financial statements that you would otherwise do.
How early should a company start documenting and testing key controls if it's targeting an IPO in, say, 18 to 24 months out?
Immediately. So, yes, it takes time to mature. I'm interested in Steve's response as well on this. But sometimes one of the mistakes that companies make is they procrastinate on this. But it takes time to put in policies and procedures and to get people to operate in a way that they can repeat the same process and have it work effectively. And like Steve said, it's also documented that it works. You have proof that it works. That way it can be audited, and you want to pass that test. What you don't want is a large number of significant deficiencies or a material weakness, what you do not want. So the earlier you start, the better. 18 months before an IPO is a good window. I'm interested in Steve, what you have to say there.
Yeah, so one thing that I see with a lot of private companies I work with are thinking of doing an IPO. They do an AICPA audit, and as part of that, yes, there's a kind of a lower level of you have to do procedures for that level of audit. But as you get to the IPO, a lot of companies, what they'll do is they'll redo their audit at a what's called a PCAOB audit, which is a different level of testing, different level, more disclosure, more notes, more work itself. At the same time you're doing that re-audit, that's when you really up your game on the Sarbanes-Oxley time as well too. Because just as a practical matter, you're a private company, you don't have a huge budget, you're going to just want to do the minimum you possibly can, give your audit, your basic, GAAP, gas audit to your, lenders who are not going to require that. But then you decide, okay, we're going to really hit the IPO, and we need to redo the audits and redo all these SOX procedures, and that's where it's game on, and the floodgates open in terms of you trying to add all these additional layer of SOX procedures that you didn't have to do as a private company, and the additional procedures that you'll need to do the PCAOB audit as well.
Are there any, in your experience, common areas where there may be some internal control gaps that you see when private companies are beginning their SOX readiness?
Yeah, absolutely. So the first one I would say, which we talked about, is starting too late, because then if you start too late, it's a rush to get those in, and you can't expect that people are going to operate those effectively. So don't wait. Even if you're a smaller company, if I'm the CFO, I have to sign off on the first quarterly results to say that this number is accurate. I want to have good controls in place to know that I have the supported controls to verify that that's an accurate number. But here are some other common areas that you'll very commonly find. And it's, as Steve mentioned, companies, they want to operate in a way that it's they're being very responsible with the money that they have. They have limited money before they're public, and they have to operate in a small footprint. So segregation of duties then becomes a very common issue. And so with segregation of duties, do you have the same person setting up a vendor and also paying and approving and reviewing things? Those are not good practices. So either for segregation of duties, the recommendation then is either you have more people to separate those duties. IT general controls is a common one because there's more rigor around access, granting access, reviewing access, making changes to public IT systems and how you document and approve those changes, the security around those systems, the key general controls. So ITGCs is an area of common issues. And then the other two I'll just mention real quickly: revenue recognition, because it's so judgmental and there can be errors there. Financial close controls and the reviews around financial controls, just because it requires more rigor. Okay.
Well, you mentioned IT general controls, Eric, and feel free to stop me with this question if it's going to derail things. But do you have any thoughts on best practices for implementing and testing your IT general controls in a rapidly evolving tech environment? I'm thinking AI tools are being deployed rapidly across all industries, and I imagine there could be some risks if a company rolls out some new AI-enabled technologies into its workflow right before an IPO.
Yeah, absolutely. There's a whole set of governance requirements just around AI, like monitoring, knowing how decisions are made. There's a whole AI governance model for that alone. So those need to be considered on how decisions are made. And you have to just make sure that it's the security management piece is a big piece around IT, as well as making sure you have controls over who can make changes to public data, as well as the public systems, who can implement those, who has access to those. There has to be rigor around that. It can't be open.
The only thing I would add on the systems front, and I know you say kind of upgrading it, but I think just when I hear that, I think kind of switching from QuickBooks to Oracle or something, or whatever the latest technology is. But I typically don't see that in connection with an IPO, because that's just a whole nightmare of a work stream, and that can be a multi-year project as well. So I think that you make sure your system's good enough to survive the auditors once you upgrade to the PCAOB audit. Make sure you can get through that. Yes, there'll be fine-tuning everything that Eric just said that you'll need to do with respect to that, but you won't actually upgrade your technology until it's a clear day and the smoke is cleared on the IPO and you're off and running and making sure everything's working smoothly at that point. Or the flip side is, if you've got the big budget, you can do that 18 months in advance of the IPO and make sure all the bugs are worked out. Because once you get to the IPO, there's going to be so much work going on at the same time. It's really a second job, and you don't want to add a third job of implementing a new IT system on top of that.
So looking ahead, once an IPO is complete, what might be the biggest surprise or surprises a newly public company's finance team might encounter in their first year under SOX?
I think the big thing is that the level of documentation, of the rigor of policies and procedures, and that what you don't want is this. You don't want a material weakness, and it's becoming, unfortunately, it's not uncommon with a new public company to have a material weakness. But me, if I'm the CFO, I do not want to shake my investors' confidence. Material weakness or 5, 10 plus significant deficiencies. I mean, come on, that can shake an investor and say, well, how is this company operating? I don't want to do that. I want to have good controls in place.
One of the things, being the non-finance person that I really see from the outside as well is just in terms of timing. Once again, private companies, you may have 180 days to do your audit after the end of the year. You may do 0 for the quarterly. And then all of a sudden you're told that here's our strict deadline. We've got to get the audit done, 85, 90 days after the end of the year. We've got to hit the 45 days for each quarter, got to produce a huge, 10K, 10Q at the same time, which you're not used to doing. The good news is once you go through the process, there'll be a lot of practice in terms of getting that ready. But some of the things that I see management scared about the most is, how do I accelerate that 180-day timeline to 90 days? How do I, when I've never done quarterly, to all of a sudden get a process in place for producing that? And that's one of the things that, the banks are really focused on, because they don't want the company, or maybe I should say it positively, they want the company to be able to hit those deadlines, get all their key metrics disclosed, get obviously their financial statements and the technical compliance as well too. But that's something that putting aside all the technical requirements, just as a practical matter, the company needs to make sure they can hit those deadlines with the systems and the people they have.
David, I'd like to bring you into the conversation here so we can discuss a little bit from the auditor's perspective, audit and assurance. What should companies know for preparing, reviewing documentation, working with their auditors, and getting ready for an IPO from an audit perspective?
When you're looking at it from an IPO audit perspective, you really need to start with looking at the technical accounting policies that you're going to have to pull into place as it relates to your IPO. So you got to consider the fact that you're not just preparing a set of GAAP compliant financial statements, that you're also essentially developing the track record for your company. So, consider the fact that investors, underwriters, SEC, are really looking at your financials to develop the track record for determining your price and the credibility of management. So this is a lot different than what private companies are used to. So within that, you've really got to look back at when you do your IPO, what level you're going to, enter at, in terms of if you're an EGC, growth, emerging growth company, and see what periods you're going to need to pull in these financials, and essentially you have to go back and reassess from a solid qualitative assessment, the technical abilities and the information that it relates to. A lot of the areas we see, that caused a lot of issues are in the revenue recognition area. So if you have to do a 3-year, income statement, you need to go back and make sure the last 3 to 4 years are very technically solid and sound in terms of having good documentation around your revenue recognition area, as well as other areas that provide a little bit more complexity, such as, equity, especially if you're on the road up to an IPO. There's a lot of transactions you may have already entered into. You're getting into issuing stock options at that time. You may have already issued preferred stock, warrants, or other complex accounting debt or equity type instruments that require a higher level of complexity in terms of accounting at that standpoint. So you kind of got to step back and look at a lot more than just, hey, this is the year we're running up to the IPO. You've got to make sure that everything's in line and consistent, because everybody's looking at that for consistency going forward.
Yeah, you mentioned equity awards, and stock-based compensation could obviously be a big topic in IPOs. Are there any key accounting pitfalls around equity awards or modifications as companies approach going public?
Yeah, I mean, there is different accounting standards for both private and public companies that a lot of private companies may gloss over that could lead to upon the IPO, a different presentation or classification. So there's some instances for a private company where preferred stock may be classified as equity, but for a public company, it may be mezzanine equity or a potential liability, which then means now I have to account for those in a different manner. And I would actually have to go back and do potential evaluations or other accounting considerations for mark to market fair value for like 2 to 3 years past to make sure that I'm consistent in the presentation that's going in the final draft. Whereas those may have already been looked over by the auditor, signed off as equity, and now I have a reclass. It's not necessarily a restatement, but it's part of the change from going public or from private to public.
So you have to look at those complex capital structures to make sure that they're properly classified and presented in the IPO financial statements?
Yeah, because you're pretty much going to have to go back and do a complete technical analysis all over again from a different aspect. Even if you did it for your GAAP audit, you're still going to have to go back and reassess it completely different.
That sounds like a time-consuming process.
It is, and you need to make sure that you're well ahead of that. You have a good, set of timelines. You already have that plan, and need to make sure that you have the time for, using valuation specialists if that's what's going to be necessary for them to do their work, because it's not just like, a day or two calculation. Each calculation could be a 2 to 3 week process, depending on, how in depth or how complex those transactions or instruments may be.
So how do you recommend companies coordinate among their management, their external auditors, and other advisors to resolve some of these complex accounting judgments or determinations before they go forward with filing their registration statements?
Well, I mean, ideally, you really need to go through and almost, again, re-audit internally all your transactions. Everybody needs to be on the same page. So there's a lot of instances where, the CEO may, issue instruments or agreements that he may not communicate appropriately to finance or through the board for approval. So some of those may not be appropriately tracked, accounted for, or even considered. So you need to make sure that everybody essentially goes back for the last 2-3 years, understands every instrument that's out there, understands all the terms behind it, and basically have to go through everything again.
You could give one piece of advice to a CFO who was starting IPO planning today, what would it be?
Make sure that everybody communicates across all divisions, all departments about all transactions, no matter what they think, what that other department may think it might be. It might be small to them, but it won't be small for finance. And the last thing you want to do is have your timing derailed because finance needs to catch up with what, one department thought was a minor transaction could turn into, a landslide in terms of time, delays, effort, cost to bring it to what should be the appropriate accounting. And sometimes you'll end up with things brought up by, the legal or investment banker saying, hey, we don't see this transaction necessarily being shown up on your financials, but we know it's in the cap table or somewhere else. And then all of a sudden it's like, oh, well, somebody issued this, didn't tell a different department, and now you're having to catch up and delay your timeline.
Let's talk about some legal considerations for IPO readiness. So, Steve, for our listeners who are new to this process, can you walk us through some of the key SEC filings involved in an IPO?
Yeah, absolutely. Happy to. And there's really, I want to focus on one key filing, which you mentioned earlier, which is the registration statement, and that contains the prospectus as well. And so that's the key document in terms of gets filed with the SEC. That's the key disclosure document that gets set out to investors. I had mentioned earlier kind of the roadshow presentation, which is more the marketing side, but that's not really an SEC document. So with respect to the registration statement and the disclosure, there's a couple areas that we've already talked about. One is the description of the business and the key metrics. And so that's one very important section. Obviously, the audited financial statements, which we've spent a lot of time, that's the very, very important section as well. There's a couple other sections I just want to highlight. One is the risk factors, which only the lawyers love, and that's really just tells all the bad things that could happen with the business. Two, there's a section which calls the management discussion and analysis, which is really management describing what's actually driving the business. So taking the audited financial statements and translating them to investors as to, well, here's what's really going on, and here's the reasons for causing all those changes in the numbers that you see on the financials. And so that's an extremely important section of the document. That's the one where most of the enforcement actions are. That's the one that often investors turn to first to read, just to get an understanding of what is the business model of the company? How does it work? What's driving it? And that's where the key performance indicators are usually located that I talked about before. Two other sections that I want to highlight. One is there's going to be a whole section on compensation as well, and that includes all the discussion of all the equity awards that David was just talking about as well too. So that's an important section. That's not as key for investors, but it's a required section. Obviously, management has to understand, what goes in there. Management needs to get comfortable with the fact that, their salaries and compensation will be disclosed in there, but that's just a part of being a public company. And usually there's a whole separate work stream with the benefits team that work on that as well. And finally, the other big section, which I call the governance section, and that really describes the company's charter, it describes their bylaws, it describes the various, some of the policies and procedures that the companies have implemented, like, related party transaction policies, et cetera. And so that's also very key. The lawyers will spend a lot of time on that. That is important to investors to the extent you're doing something, somewhat unusual, picking an unusual state of jurisdiction, having, some type of super voting stock, having other, shareholder friendly or unfriendly perceived type of provisions in there, like anti-takeover provisions, as well as what your board is going to look like, who's going to be on various committees, and so that's a very important work stream as well too, that the board itself are going to be very focused on. And so there's within that, you've seen already, there's at least 6 significant separate work streams that all need to come together in one document and tell a consistent story about the company and how you're presenting yourself to the market as well. And I mentioned the board briefly, but that's something that you should also keep in mind, that's super critical throughout this whole process. A lot of times boards change. Some old directors may not want to continue, or you may not want them to continue, as well as adding new directors with new skill sets and new public company experience. But oftentimes they want to be educated on this process as well too. So we and the accountants and the banks will also carve out time to just educate the directors, both the new and the old, as to, here's the things you need to be concerned about as a public company. Here's all the SOX procedures that we've talked about. And here's why they're important to you. Here's all your disclosure obligations, and here's why that's important to you. Here's all the fiduciary duty obligations that you have, and here's why those are important to investors. And here's what investors are looking for in your communications with investors as well. So, because the communications is a whole separate work stream as well too. One thing I will note, just because we've been talking a lot about, kind of the registration statement, which is really kind of the historical business you do talk about going forward. But one whole separate work stream that's super critical here is your projections, because that's how your business is valued. And so, yes, those will be based on the historical trends in your financial statements, but those are also super important because that's part of how you tell your story going forward. That's how investors are going to value you, and that's how you're going to be measured going forward as well, too, to the extent, how close or far you come from those. And you want to obviously show a good story and have good projections, but you also want to make sure you can hit those. as well too. And then there's not going to be unusual swings in your business that you're going to have to explain, a quarter, 2 quarters, a year later that, oops, I forgot to tell you that, we have to change our product in a year. We have to, make this huge expenditure that wasn't in our plans. And so that's also another work stream that you'll have to keep in mind here.
Yeah. How do you help management in that area of projections, forecasts, forward-looking statements that they're going to have to do when they are a public company? How do you address that in the IPO process? Is that something that you're trying to set them up for, or do they already need to be doing those projections pre-IPO?
They should hopefully do it as just part of their normal financial planning and analysis. That should be a normal exercise. Once again, it just you take that work stream that most companies already have, and it really turns it up a notch in terms of the significance and the importance, and who's going to look at that as well. We really help by helping companies think about how that's going to be used, as well as just testing the assumptions as well, and just focusing on, okay, what are the trends in the business? Why are you showing 5% historical growth in your revenues, and all of a sudden you're showing 35% going forward? What's going to drive that? What's the reason? That's a kind of a crazy example, but I have seen worse things that come out. But it's really just us, and also the bankers as well, will just help probe and test and think about what's important and how that drives the disclosure, and they all kind of link together too, because for example, there's a trend in your projections that you expect XYZ to happen. We also need to think about, okay, how does that work into the prospectus as well, where we talk about, hey, here's a trend we're seeing in our business that, or we expect our international business to explode over the next couple of years. It might have been 1% pre-IPO, and we're projecting it's going to go up to 40% of our business. And so that's the kind of thing where you just have to communicate as part of your story, so you have the credibility that, yes, here is a huge focus of our business going forward, and that's why our projections are credible, because we're telling you we're going to do that, we're going to invest in here, and so it's really just kind of us probing and testing.
Are there any sections of the registration statement that tend to be the most time-consuming over and over in every engagement, or does that vary widely depending on the company?
It's really the business section. That's the one that's kind of beaten up the most, because everyone has a view as to what it should read like, and the company obviously has their own tone and their own perception as well. So if you look at a drafting sessions, I'd say 60 to 80% of it is really spent on the business and just how it's positioned as well. I'd say the next section that probably gets the most focus is the MD&A. Once again, because that is really describing how the business is, and there's a lot of different ways to do that, and that's going to what we were talking about earlier on the KPIs, is how you position it, how you position this growth, what kind of trends are you going to be talking about. And so I would say those are the two most important sections, and those are the ones that the business people should focus on. The rest, I hate to say it, are a little bit more kind of lawyers and accountants doing it, but I'll leave it at that.
What are some of the most common legal issues that you've seen derail or delay an IPO, and how might a company spot those earlier in the process?
I think it's unknown liabilities or contractual issues. I think that's something that comes out in the diligence, and sometimes you can disclose those away, and sometimes they're significant enough where you can't. I know David talked earlier about your pre-existing capital structure. Sometimes that's messy. Sometimes the negotiations with investors or what things are going to look like post IPO can be messy as too, and that can push things out. I know there was a little conversation earlier about accounting issues as well. We oftentimes will go to the SEC in advance of an IPO and try and pre-clear accounting issues too. So sometimes that will delay things a couple of weeks. When we're trying to get the SEC buy-off on our particular maybe a novel way of approaching an accounting that no one else has done it, or a different way that we think that we're different from the rest of the industry for these factual reasons. And so that can have a little delay in the process as well too. The other thing which kind of just legally can delay the process is where the company leaks and starts talking to people and saying, hey, we're doing an IPO, start looking for us, because that's known as gun jumping, and that's where the SEC famously tells companies, sorry, you got to sit on your hands for 6 months and wait for that to get cleansed and out of the market. So, but thankfully we give that lecture to companies, and so it rarely happens the ones that we're working with.
When you're in SEC pre-clearance or review, what are some examples of comments that you frequently see from the SEC staff?
I think that on the accounting side, a lot of it is revenue recognition. That seems to be kind of one common theme. It's funny, like over the years, the number of comments have really gone down. There was a time period where you'd get well over 100 comments, and now we're seeing sometimes between 15 and 20 comments on it. The number of legal comments is also diminished pretty significantly too. So I think the SEC has kind of really started to focus more on the really important issues and some that are unique to the company. And sometimes they will challenge that. And I think David mentioned this a little earlier as well too. Sometimes they'll look at what's known as a cheap stock issue, and that's the prices at which the equity has been issued leading up to the IPO. Once again, I've been seeing less and less of that issue, primarily because everyone on the lawyers and the accountant side are so focused on it going in that it's usually so completely scrubbed that the SEC really doesn't have anything to add on that perspective. But that is something that they do focus on, because that can lead to a one-time charge at the time of the IPO, which investors typically don't care about. It's just, from accounting, to the extent you have to take $100 million charge, you just have to explain it away and say, oops, we have a cheap stock charge, but never mind, it doesn't affect our business going forward.
Has the staffing level at the SEC remained pretty constant? Because I spend most of my time in my practice, which is IRS tax controversies, dealing with the IRS, and their headcount there is reduced by about 25% in the last 12 months. So is the SEC headcount down as well? Or is that
I don't think it is, but I've participated in some panels with the some SEC senior staff, and I think what they've done is like to tell them to really focus more on the important issues, and so that helps reduce their workload a little bit. So I think it's the same number of staff. The good news is, well, the bad news for us, but the good news for them is the IPOs have been down the last couple of years, so they've had not as much volume coming through the system. But like any system, if we hit the 300 IPOs that Derek was talking about earlier, look, that's going to be a huge drag on the system. But I think that they're definitely focused on the important issues, and they're not going to be trying to spin their wheels or the company's wheels on the more minor issues.
I've got one last question for you here. If you had to give leadership a 90-day action plan to reduce IPO risk and compress their timelines, what would the top 3 moves be? And what's something that they should probably stop doing immediately?
Well, I talked about stopping to talk about the IPO, so that's the obvious one. I'd say that the number 1, 2, and 3 issue from my perspective is get the PCAOB audit done. Because that drives everything. The lawyers can work as hard as we want, but if you don't have the PCAOB audit, then nothing happens. So that would be my number 1, 2, and 3 thing in terms of getting the process going. This is the most exciting time for our companies. It is double the work. You will be doing your day job, and you will be doing this job as well. So the other thing that, in response to one of the questions you had earlier, was what would you advise a CFO? I'd say get resources. Because the volume of the work will shock you. And so you need to really staff up internally. Like I said, there's external organizations that can help support you as well. But just in terms of processing all this documentation, we were talking about for SOX, processing the registration statement, processing your projections, getting ready for reporting. That is a massive amount of work, and I would just say get resources.
Yeah, I would agree 100%. And that just to emphasize too, the start early, don't procrastinate, enjoy going IPO and not having so much to worry about that's not done because you waited to the last minute. So start early. One thing I didn't talk about too is I also work with the external auditors to understand their approach. They're not going to advise me or consult, but I'm going to understand each one is a little different. So I understand their approach, where the risks are that they're looking at, and to make sure that those are addressed, and to make sure the timing is right as well. They have certain timing that they follow so that everything goes smooth, both for management and for the external auditors.
Yeah, so I would just add that, make sure you have good communication liaison between all the groups. Make sure your timelines are all aligned between all groups, attorneys, bankers, your auditors, internal staffing as well, to make sure that everybody can hit the timeline and keep it moving forward through that period.
Great. Thank you, Eric, David, and Steve, for sharing your insights with us on IPOs. And if you're considering an IPO or you need help with other issues, please contact Eric and David at SingerLewak and Steve at Latham Watkins. Thanks for listening to The Balancing Act.
Thank you for tuning in to this episode of the Balancing Act podcast. Today's episode focused on IPO readiness, what companies need to be thinking about before going public, from financial and operational preparedness to risk and compliance considerations. Be sure to tune in for our next episode when we cover AI and cybersecurity.